It's one of those periods where the supply-demand growth is beginning to balance, which is nice to see. In fact, that balance is at a point we haven't seen for a couple years, and that's why you got the 26 to 46 bounce. But 60 is going to be the hard spot because last spring, that's where the rig count jumped. That's where we'd expect production to come online. And that's very typical, too. Once you get into these bear markets with something like oil, you'll get the bounce, the 26 to 46 type bounce, like we did back in the 80s. But eventually what will happen, price, it will go sideways for a few years. You just got to find where that top end of the range is, and it's probably going to be 60 because that's where the rig count increased last spring.
Bob, we spoke to you last at the beginning of April, and you said back then that daily prices could be in the 20s. You're less bearish now, but you say the market is vulnerable to a pullback to the 30s. What would take us back down to those levels?
Well, very difficult to time or predict the catalyst. Last year, we didn't correct until early July, and it was the Chinese stock market melting down that did it. This year, it could be a macro thunderclap, could be an OPEC meeting or signs of Saudi Arabia perhaps increasing production later this summer, or could just be something that triggers market awareness of the large glut that we have and yet the large long positions in the futures market. So it's more a question of, are we overextended? Are we vulnerable to a pullback? I think that's really the question. And again, we had to wait till early July, and it was a Chinese stock market last year. Really difficult to time, but I do think the market is ahead of itself. What has changed, importantly, is the disruptions we've had from Nigeria, from Venezuela, from Iraq, from Canada, even Italy is out 75,000 barrels a day on a corruption scandal. We have had a spate of unexpected disruptions this year, which makes the bear case harder to sustain and probably means any pullback will be less.
John, when you take a look at oil, and let's say your forecast of 50 is in the cards and it does happen, and we trade somewhere between 50 and 60, are you worried that the U.S. producers are going to come back online and that is going to be the sort of self-fulfilling cap on oil prices?
Absolutely. If we go back to the 80s again, what happened when commodities went into their bear market was your marginal cost to produce came down. And it makes a lot of sense. Energy goes into producing energy. So with prices as low as they are, and the rig count came back on around 60 last spring, your marginal cost to produce is probably less than 60 now. Maybe it's 57, maybe it's 58. But the longer the bear market goes on and oil prices stay relatively low, the marginal cost is lower, which just increases the odds that some of these marginal producers will come back.